Hello, welcome to this week's podcast. It's brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson. Joining me again is Pepperstone Senior Market Strategist Michael Brown. Hello, Michael.
Very good afternoon to you, mates. Currently enduring the fourth heat wave of the summer in an office with not very strong air conditioning, but I believe it's nice and cool down on the coast where you are.
Yeah, it's about 5 degrees cooler here than it is in central London. Getting a fairly nice sea breeze off the English Channel, so that's nice.
Lucky you.
Indeed. But this room does get rather warm when the sun's shining on it because it's south facing. So windows open. So if you hear any dogs or crying babies or what have you, nothing to do with me. Anyway, let's talk about.
That might be more important than the actual disclaimer that you've got to read out.
Indeed, but obviously, let's talk about the markets. Maintain their resilience this week. S&P 500, Nasdaq continuing to make new record highs. Dow and Russell lagging somewhat, though the Russell has had a fairly decent last couple of days. European markets continuing to be fairly boring, treading water below record highs. FTSE 100 still remains within touching distance of record highs of around about 91.89. It's around about 91.55 as I talk to you right now, looking at my screen. So all in all, despite the mixed nature of the data that we've seen this week, nothing too much to worry about, it would seem.
No, and I think obviously we'll get into the meat of things momentarily, but markets have very much gone all in on the idea of a September Fed cut, and it's kind of given the green light for equities to just keep running on to the upside. And I guess the question now is, does Mr. Powell want to throw a spanner in the works at Jackson Hole next Friday?
Well, we'll talk about this in a minute, but some of the data that we've seen, particularly today, suggests that maybe the Fed would be wise to wait. But before we get into that, let's do the risk warning. The information provided here, whether from a third party or not, is to be considered as a recommendation or an offer to buy or sell, or the solicitation offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 73.7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so obviously let's do the topics first.
Yes.
So there's a nice little summary of what we're going to be discussing. Obviously, we're going to talk about what's been driving markets this week. Trump is continuing to bash the Fed. He's drawing up a candidate list for a replacement for Jay Powell. We've heard comments from Treasury Secretary Scott Bessent saying that he thinks that the Federal Reserve Fed funds rate should be at least 150 basis points lower. I say cobblers to that. So money in the swear jar there. So we'll talk about that. Talk about the US CPI print this week, as well as today's PPI print, the divergent nature of those two numbers. UK economic data, bit of a mixed bag. We saw unemployment and wages on Tuesday. We've seen second quarter GDP today, which came in much better than expected at 0.3%, well above 0.1%.
Champagne ready?
But yeah, pop the old champagne corks. Everything is awesome. But dig a little bit below the numbers, and actually not everything is as rosy as his numbers might suggest, so we'll dig into that. Look at this week's headline numbers from UK. Balfour Beatty and Persimmon had their latest first half updates, and here again, bit of a mixed picture. And then we look ahead to next week, and obviously we've got CPI out of the UK, UK retail sales as well for July. Both numbers are for July. We've got the Jackson Hole Symposium, and the topic on that is labour markets in transition, demographics, productivity and macroeconomic policy. So there's going to be a broad discussion, I think, about that and what that might tell us about the Fed's signalling as we head to, obviously, the interest rate decision on the 17th or 18th of September. And then we'll look at the numbers for Walmart, Target and Home Depot and what they tell us overall about the health of the US economy, as well as touching upon flash PMIs, and maybe do full year numbers from Hayes, the employment agency, which in the absence of accurate jobs data could actually give us an insight into not only the UK jobs market, but global employment trends in general. Easy for me to say. Anyway, let's start with Fed and Trump and some of the candidates that he's lining up to replace Powell.
Yes. What is it now? 11 in the mix? Surprised your name hasn't been mentioned just yet, mate. It's easier. We're getting to the point where it would be easier to name people who aren't in the running for Fed chair. We've got, governors.
I'm not a yes man.
Well, exactly. We've got current Fed governors, we've got current regional Fed presidents, we've got former Fed governors. We've even got folk on the sell side like Rick Reeder and David Zervos who are now being mentioned. Do you know what I think this is all about, though? I think there's two things going on here. One is we know Trump loves drama. He loves a soap opera. I mean, he used to produce The Apprentice, for goodness sake. He's basically running the contest for Fed chair as if it was an episode of The Apprentice. Again, all the limelight's on him. He's the main man, etc., etc., etc. He's got the power. The other thing that I think is coming into all of this is by naming or just dropping hints into the media of people who might be in the mix, you're increasing the attention on the remarks that those people are making. By and large, the names that he's suggesting are making remarks that are dovish, that are critical of what the Fed is doing. And I think that's just another way for the administration to be putting pressure on Jay Powell, which is frankly disgraceful. And it's an erosion of monetary policy independence, which shouldn't be happening. But we see it all over the place. Trump himself is talking about the need. I think he was talking last night about the need for rates to be 4% lower. I mean, that's just ridiculous. Obviously, Besant talking about 150 basis points of cuts. And now you've got all these potential candidates out in the media as well, touting big rate cuts. It's all just trying to push the Fed in the direction they want it to go, I think.
Yeah, and yet I think a lot of them are still standing firm. I think you had Mary Daly today saying that she doesn't see a case for even a 50 basis point rate cut in September. And that's certainly something that Besant was talking about on financial TV as recently as, I think, yesterday in the wake of that US CPI print, 2.7%. And everyone was talking about the fact that that number makes it more certain that the Fed will go by 25 in September. Excuse me, guys, did anyone actually look at the core CPI number in that? That went up to 3.1% in July. So why does the benign headline CPI reading make it more likely the Fed will go by 25 when core CPI jumps to 3.1% and the highest since February? I'm sorry, I just don't get the mindset behind that thought process.
No, I mean, I'm as confused as you are with that one. I mean, the headline numbers were, I wouldn't even say good. They were just okay. 2.7% on the headline CPI is not something we should be celebrating. Exactly. But as you dug deeper into the report, things got worse and worse. As you say, core inflation rose 3.1%. Super core inflation, which is where you take out housing costs, that rose 3.2%. If you look at core goods prices, which are where you're going to see the pass-through of tariffs coming in, they rose by 1.2% on a year-on-year basis. Now, before anyone goes, oh, that doesn't sound very high, admittedly it's not, but 6 months ago, core goods prices were in outright deflation. They're now at 1.2% and continuing to rise. And even if you just want to focus on the headline metrics, headline CPI has now been above 2% for 53 months in a row. And for me, I think if the Fed were to deliver a rate cut at the September meeting, then you can just basically wave goodbye to any sort of pretense that they're actually trying to get inflation back towards that 2% target. I mean, it's almost 5 years now that we've been north of that figure. Not only are we stuck stubbornly above that 2%, we're moving up further away from it, and the forecasts are that we will continue to move further away from it. So I don't don't really understand how anyone can look at that report, and certainly market pricing. I mean, where are we now? 95% probability of a September rate cut. It just seems like everyone's sort of run away with themselves a bit too much here.
Even after today's PPI numbers. I mean, today's PPI numbers, I mean, if they're not a shot across the bows of the doves, then I really don't know what is. I mean, people talk about transitory. And to my mind, I think that word needs to be banned, because I'm sick to death of hearing economists bang on about transitory. Inflation may be transitory, it may pass through, but it's permanent for the people who pay the higher goods and service prices if their wages don't go up by the same amount. So, to all intents and purposes, it's just another one of these meaningless words that I would consign to the dictionary or the dustbin of, phrases that people use. And to be fair, Andrew Bailey has stopped using it.
Yeah, well, I think most central bankers probably have, because they were scarred from that experience in the aftermath of COVID. I mean, frankly, on a long enough time frame, everything is temporary ultimately.
Well, exactly.
But what sort of reasonable time frame are we looking at? Because as we were just talking about, the last time the Fed hit their inflation target was 2021. I would say 4 years is far too long to be this far away from your inflation objective and not even making progress towards it. The more worrying thing I would argue about the PPI print is you've got to remember that it doesn't include imports. So there's actually no direct impact from tariffs in that PPI data. And it still came in at 3.3%, well above anyone's expectations. So again, inflation risks are clearly tilted to the upside. That's clearly coming through in the data that we're getting. And I just wonder whether, if and we'll get onto this later on, but if Powell does deliver a bit of pushback at Jackson Hole on the idea of a September cut, I think markets are going to end up throwing sort of almighty tantrum to wrap up the month of August.
I mean, I know why Trump wants lower rates, but ultimately, even if the Fed were to cut by whatever amount he wants, ultimately it's the market that decides where the rates are. So I think all this chatter from the likes of President Trump, as well as an awful lot of armchair commentators, and obviously we are armchair commentators for want of a better word, but these armchair commentators who are criticising the Fed for being too slow, I think it just comes across as completely reckless. I mean, yes, okay, the people making the most noise is the US administration. They want rate cuts. But ultimately, rate cuts will only deliver so much. And the only reason rates are as high as they are is nothing to do with, the Federal Reserve holding them too high for too long. It's because that's the rate that they think the economy can cope with.
Yeah, and it's also an example of the administration, the Trump administration in particular, not wanting to take or make the hard choices that are necessary in order to bring spending under control and to bring the deficit under control. You look at in the United States, Besant came in saying you're going to get the deficit down to 3%. Well, they haven't passed anywhere near the degree of spending cuts and are just kind of taking the easy way out of let's get the Fed to lower rates and hope that lowers our debt interest bill. I think quite. And I think the reaction to the CPI numbers this week was telling, because you did have a dovish repricing. You did have markets go effectively saying, September's a certainty in terms of a cut. But what happened to the Treasury curve? It steepened. What happened to yields at the long end? They rose. The 30-year yield rose after the CPI report, which to me tells you everything you need to know about how the market is viewing the potential for rate cuts. Fine, they may be coming, but if they do, all you're doing is massively raising the risks that inflation not only becomes more embedded within the economy, but also that inflation expectations become massively unanchored from that 2% target.
And obviously households, their inflation expectations will change as well. And I would argue that's an even bigger problem. If consumers' inflation expectations become unanchored, if you like, that can affect their spending behaviour massively. Yeah. And the US is a massive consumption-driven economy.
Yeah, absolutely. I mean, the US economy probably for the last 5 years, if not longer, has been powered almost entirely by consumer spending. And if that does start to stutter, then you're in for a world of trouble, which, and I know we'll get onto this momentarily, is in direct contrast to the UK economy, where growth is being powered by the government spending as opposed to the consumer doing any of that spending.
Yeah. I I mean, obviously that was something that I talked about in my sort of a summing up of what we were going to be talking about. Dig a little bit deeper, and the numbers don't tell the whole story. So yeah, I mean, as I say, so for me, the inflation picture in the US, it's not as benign as people would like to, or the administration would like to have you think. And
No.
ultimately, the US economy may well be slowing, but it's not because interest rates are too high. It's because the prices are rising and the uncertainty over tariffs means that consumers are being an awful lot more cautious. How do I know that? I got family in the US, so that they're telling me firsthand of how they feel about the economy.
And this is very close to the point that we touched on, I think, a few weeks ago in the aftermath of Governor Chris Waller at the Fed, talking about how the labour market is seizing up and lower rates are required to sort of cushion the impact. Well, the problem in the US is not the cost of credit. The problem is that businesses and consumers alike are being paralysed by higher prices, as you rightly say, and by ever-changing trade and tariff policies from the administration. You could, if you really wanted to, and let me say, I don't think the Fed are going to do this, you could do what Besant wants and lower rates by 150 basis points tomorrow. Is it going to have a sustainable impact in terms of improving the labour market if trade uncertainty remains at the current level? I'd argue absolutely not. A business who is pausing their investment decisions, or a consumer who is not pulling the trigger on a big ticket purchase, they're not going to suddenly change their mind because interest rates are 100 basis points lower if they still don't know what the tariff landscape is going to be tomorrow, let alone in a year's time.
I think if the Fed cuts by 150 basis points, I think that's going to be the least of your problems.
Well, yeah, there is that as well.
Because it'll be the market reaction to that.
Yeah,
that you'd have to digest. And to be quite honest, the market reaction to that could be quite febrile.
Yeah, I think the long end would have quite a strop if that were to take place, let's put it politely.
Because it's not driven. That sort of move is not driven by the fundamentals. And ultimately, it would damage the Fed, I think, beyond repair when it comes to perceptions of its impartiality, if you like, or its neutrality.
No, I would completely agree with you on that one.
Okay, well, I think we've probably done that topic, and we will circle back to it when we talk about Jackson Hole.
Yes.
UK data this week. So, earnings, weekly, average weekly earnings, 5%. People were making a big deal about the fact that the numbers for including bonuses came in lower. But that's not the one I look at. I couldn't give a monkeys about bonuses because they're discretionary. They come and go. It's the core number that I'm looking at, and it's the one that doesn't include bonuses. And that remained unchanged at 5%.
Yeah.
Unemployment, steady, 4.7%. Let's not forget, though, that a year ago, just over a year ago, it was at 4%. So it's higher, and the labour market does look a little bit weak, and it provides a bit of a headache also for the Bank of England, given today's or this morning's second quarter GDP numbers, because ultimately it suggests that there's probably not an awful lot of room for a rate cut yet.
No, and I don't think we were really thinking seriously about the prospect of a September rate cut, given how finely divided the MPC were last week, and we're certainly still not thinking about one in the aftermath of that jobs data. I guess the best thing you can say about the UK labour market is things didn't get materially worse over the last couple of months. Unemployment holding steady in the 3 months to June, as you said, although there's obviously still question marks over the accuracy of that data. Payrolls, according to the PAYE data, they fell by 8,000 in July, which is a fair chunk, but it's nowhere near the falls of sort of 20, 40,000 that we were seeing in months gone by, although it is still the 8th decline in payroll employment in the last 9 months. So I guess you could argue that things are starting to bottom out a little bit. The thing that's obviously concerning, as you rightly alluded to, is that earnings pressures are still too intense. I mean, generally, you'd kind of say, as a rule of thumb, earnings growth of 3.5% is roughly compatible with the BOE's 2% inflation aim. We've got earnings growth running at 5%, really, no matter what metric you look at. But the interesting thing about that, again, just sticking with the theme of the show, which is digging deeper into the data, again, we saw earnings growth in the public sector outpacing earnings growth in the private sector, which is quite a worrying trend. And it's also, I would argue, quite an unusual trend, given the typical dynamics. No, not at all. I was just getting the figures there. Public sector pay rose by 5.7% in the quarter to June. Private sector pay rose by 4.8%, both of those metrics excluding bonuses. So, when we're looking at a government that's constantly telling us about fiscal black holes and the need for spending restraint, well, how about we rein in some of those pay rises? That might be a good place to start, Miss Reeves.
Yeah, particularly in the public sector. And it was also notable that an awful lot of the heavy lifting in the second quarter numbers was done by virtue of spending in healthcare and social care to improve the NHS. And before people shout at me saying, well, we should be improving the NHS, yes, I agree, but not at the expense of the private sector, which absolutely. The Chancellor of the Exchequer is taxing into oblivion. Here's a stat for you. It's from the Centre of Policy Studies, and apparently it costs the average employer an extra £2,367 to employ a worker on the minimum wage. £2,367 extra as a result of the increases in the minimum wage and the increases in national insurance.
I mean, that's staggering.
Yeah.
And, it doesn't take a macroeconomic genius, to work out that if you raise the cost of employment by that much, businesses are going to A, employ fewer people, B, pay those people less, and C, pass on a chunk of the increased cost in the form of higher prices. And we see that with supermarkets and food prices, for example. And that's before you consider the costs that you can't really account for quantitatively with all of the increased red tape and all of the changes in workers' rights that the government want to bring in. It's frankly an anti-business agenda that's being pursued, and the data we're seeing on the labour market bears that out completely.
And if you want to increase spending in the public sector, you need to increase tax revenue in the private sector. And it's not a question of increasing taxes on the private sector, because if you tax the private sector more, there'll come a point where those tax increases are actually counterproductive. We've already seen it in the last budget. Now we're potentially talking about the same thing in the next budget. She needs to cut public spending in areas where there is too much waste.
Yeah, and I completely agree. But this is where you come back to the issue of what's ultimately a bit of a doom loop here in the UK from a fiscal perspective, because on the revenue raising side of things, as you rightly say, I think we're probably already at that point where further tax hikes are going to be counterproductive, whether they be personal taxes, consumption taxes, business taxes, whatever. I think we're at pretty much the limit in terms of how high the tax burden can feasibly go. And then on the spending side of things, it's exactly what Scott Bessent said about the US economy. One of the few things he's said I agree with recently. The problem is in terms of spending, not revenue. But MPs in the Labour Party will not vote for the spending cuts that are required. So Rachel Reeves finds herself stuck in the middle of this shambles, ultimately, where you can't raise more revenue without denting demand significantly, which is obviously going to pose its own issues. And you can't cut spending, or at least not to the degree that's necessary, because your own party won't countenance it. I don't know how you resolve that problem.
It would take a fiscal crisis imposed upon the government by the bond markets. At the moment, the bond markets are benign. They're a little bit sceptical because there is a premium on UK debt relative to its peers in Europe and the US. But at some point, the market will take a look at the government spending plans and think, you're having a laugh.
Yeah. Absolutely. And of course, the other thing, that you speak about spending, there's ways that you can effectively fudge the numbers. I mean, the last Conservative government did exactly the same thing.
That.
Where
I've got no time for them either.
Yeah, you just pencil in a chunk of spending cuts in the last year of the OBR forecast that everyone knows are never going to be delivered, but the OBR have to model it, which means you meet your fiscal rules. At some point, no matter the political allegiance of the government, the market is going to wake up and smell the coffee on that front. And I think it's just a case of what's the trigger for that to happen. But certainly I wouldn't want to be long of the long end of the gilt curve. Let's put it that way.
No, I mean, let's look at the GDP numbers. I mean, there were some positive contributors as well. Basic pharmaceutical products and pharmaceutical preparations saw very strong growth in the second quarter, but I think we can put that down to a little bit of front running on pharmaceutical exports to the US in the event that Trump imposes huge tariffs on the pharmaceutical sector. So what they've done there, I think, or what looks like they've done there, is they've front runner the possibility that Trump could impose significant tariffs on that particular sector.
Yes.
What else is there? I mean, basically that was in manufacturing. So basic pharmaceuticals, that was a big growth driver. And machinery and equipment was slightly better than it was in Q1. But by and large, it was negative. Food products and tobacco, beverages, tobacco, basic metals and metals products, other manufacturing and repair, all negative in Q2. In fact, only 5 out of 13 manufacturing subsectors in Q2 saw growth.
It's not it's one of those reports where, again, if you look at the headline, you go, well, you actually wouldn't go, that's great, because it's 0.3% growth, which we really should not be celebrating whatsoever.
It's still okay.
It's okay. It's better than it could be, and it's certainly better than both the market and the Bank of England were expecting. The problem is the details of it are incredibly disappointing because, as you said, it's all been propped up by government spending and the public sector, and business investment fell by 4% on a quarter-on-quarter basis, and that's the telling stat for me. Is that fine, you've got headline growth, and you can rant and rave about that as much as you like, but if businesses aren't investing in the UK, and we know that there's been a problem in terms of falling business investment for a number of years now, if we can't arrest that slide and turn the tide on that one, then that's the real concern for me.
Well, that needs to be the long-term plan.
Well, there isn't one. There just isn't a long-term plan.
Encourage businesses to invest. So the headline will be the UK fastest growing nation in the G7 for the first half of this year. Okay, fine, brilliant. But what about the next 6 months? The 6 months after that, and the 6 months after that?
And also,
sorry, go on.
No. I was going to say you're comparing yourself to economies that you arguably don't really want to compare yourself to. I mean, the United States growth has been dragged massively lower by that surge in imports that we saw in Q1, as we know. Do we really want to be bragging about the fact that we're outpacing Germany and France? I mean, growth in Germany has been non-existent for about 2.5 years now, for goodness sake. It's a bit of a low bar that we're clambering over to celebrate there.
Yeah, indeed. I mean, basically, and as for France, don't even get me started on that, because essentially they're not in much better shape either in terms of manufacturing or services either. So, it's really a question of, which drunk at the bar is the most attractive.
And, what an analogy that is.
Well. It is what it is. But I mean, and I think that's the real concern for me going forward. Yeah, good headline numbers on the face of it, but there are signs of concern there. And you obviously mentioned the 4% decline in business investment, and the fact that ultimately businesses are slowing their hiring processes. And according to the ONS, 164,000 jobs have been lost, mainly in hospitality and retail, since the government came to power. That's an ONS stat. It's not a me stat. That's an ONS stat.
And also, you would generally consider a lot of those jobs are entry-ish level, lower income jobs. And of course, if you're raising something like national insurance and raising the minimum wage, that's going to have a disproportionate negative impact on that bottom end of the income scale in terms of where the negative impact on employment falls.
And holiday jobs, seasonal jobs.
Yeah,
that people just aren't being taken on because it's just too expensive.
You can't afford it. Yeah,
afford it. Because the rate or the extent in terms of costs has gone up by £2,367 since 2024. So that's potential profit going straight out the door. And that's per person. Who's going to do that?
Yeah, it's mental. Absolutely mental.
In my day, you didn't have these sways of employment regulation. You did a Saturday job, you did it for cash in hand, and it was an extra bit of pocket money. Nowadays, the government wants to tax anything and everything, and ultimately, all that does is it just stifles enterprise. For young people who want a little bit of extra pocket money on the side.
Yeah. No, you're absolutely bang on the money.
It's just nonsense. Anyway, I digress.
We'll get off our soapboxes now momentarily.
Let's look at this week's earnings numbers, particularly from Balfour Beatty and Persimmon. And basically, what do they tell us about the UK economy? Well, Balfour Beatty's numbers were really impressive. This is the last first half report for Leo Quinn, outgoing CEO. What a job he's done. He certainly can look back with satisfaction. On a job well done. He's turned around a basket case of a business, which it was 11 years ago, to a company that's now virtually a cash machine. And, this new CEO's certainly got, a tough act to follow. First half revenue, solid. I mean, there's not an awful lot to like, even though the shares did actually drop quite sharply in the aftermath of the numbers.
Yeah, and as you say, big shoes for the new CEO to fill. Leo Quinn's done a brilliant job. The earnings were pretty good. The outlook is positive. The question is, can the new man deliver on what Leo Quinn has already done? Can he build on those foundations, so to speak? I think that's what the market's focus will now fall on.
Yeah, I mean, I was looking at the revenue numbers, £5.15 billion first half. New orders up from a year ago to £19.5 billion, £2.9 billion higher than they were, and average net cash of £1 billion. So, there's not a lot to dislike. And, they kept their... that they raised their guidance ever so slightly in terms of it's targeting further growth in 2026. So on target to meet its full year forecasts, but is also targeting further gains in 2026. So all in all, fairly positive.
Yeah. And they increased their dividend year on year as well, which is always nice to see.
Not quite sure what to make of Persimmon, Michael, because the numbers on the face of it look okay. But the shares are down 3% today and trading back towards their April lows. Any thoughts on that?
Yeah, I think that's a bit of a weird one, to be completely honest with you. As you said, profits are up. The numbers were pretty decent. It is a weird one that you would see the stock react like that. I suppose the one thing they didn't do was any changes to their outlook. They maintained that outlook as opposed to improving it. But then again, given the uncertainty, certainly in the house building sector, why would you want to be upgrading your outlook right now? And they kept their dividend unchanged as well. So maybe that's a bit of a headwind to the stock. But frankly, there's not really anything in the numbers that's a big red flag or a warning sign, really, in my book.
Yeah, I know maybe it's just investors don't like housing, house builders at the moment. I mean, as I say, it's trading at the bottom of its recent range, close to the lows that we saw in April, but also the ones that we saw earlier this year. So it's still trading above its low point in January, but it's it was trading above £14 back in June. And now it's just above, or it's just below 11. Yeah. So, I'm not sure what the market's seeing that I'm not seeing.
Yeah, it feels like almost the market's looking at a different set of earnings to the ones that we've been looking at. Because to me and you, it all seems pretty decent. But the market's clearly taking a bit of a dim view of that. But then again, perhaps there is value to be found on that dip. If the company remains in decent shape and the market has oversold and that move slightly overdone, then maybe we'll rebound in relatively short order.
Yeah, I think the key levels for me, they remain around the January lows. and we're still above them. So it'd be interesting to see how the share price reacts around the lows that we've seen for this year. I think it's sometimes very easy to get caught up in the bear case when you're trading towards the lows, and then suddenly you get caught in a bear trap and the market rebounds quite strongly.
Yes.
I think the biggest concern that I have in terms of its numbers is that maybe the market thinks they're a little bit optimistic and they're going to get a bit of a slowdown.
Yeah, and that it's not going to be able to live up to
in the second
guidance
half
that it's put out. Yeah, that would be the risk in any case.
And certainly the construction numbers and the PMIs would suggest that is a clear and present concern for an awful lot of people.
Yeah, and the construction sector has been struggling for quite a while, as we've discussed on a few occasions now.
Indeed. But then again, you've got companies like Balfour Beatty blowing the doors off. So different type of construction, but you take my point.
Yeah, exactly.
CPI. Okay, let's move on to next week now. UK inflation. Obviously, unemployment numbers this week have pointed to a labour market that continues to slow. Wages numbers, 5%. Yep, fine. Okay, it's sort of plateauing, I would say, wage growth. I wouldn't say it's coming down. CPI, we saw a big jump. I was getting my drop and jumps. I was getting my drop and jumps mixed up. We saw a big jump to 3.6% in June. The Bank of England thinks that we could well see a move to 4% by September. So I think the big concern I have is obviously food price inflation, because that hit 4.5% in June. And from the evidence that I've seen from my weekly shop, prices are still going up.
Yeah, I think the inflation numbers that we get next week are going to be a bit grim, to be completely honest with you. The BOE, you mentioned them, they're expecting headline prices to tick up to 3.8%, up from 3.6% that we saw in June. Services inflation, banks see that going to 4.9%. And as you said, food inflation, the banks see that at 4.8%. So again, the figures may surprise, of course, but we seem to be setting up for another inflation report here in the UK that points to prices moving in the wrong direction. The bank, as you alluded to, said that CPI may peak at 4% in September, forgive me. And if we do get another hot report, then I think that's really going to embolden the hawks on the MPC, those four holdouts against a 25 basis point cut last week. They're going to be sat there going, well, we were right not to vote in favour of a rate reduction, because not only are prices moving in the wrong direction too quickly, but also underlying price pressures are clearly remaining pretty intense. I think in terms of the policy outlook, I don't think it's going to change too much, primarily because the next live meeting, as we were discussing earlier, isn't until November anyway. I think it's a given that the bank are going to hold rates steady at the September meeting. And between now and November, we're going to get so much data, not only on inflation, but also on the labour market, by which point the labour market may have weakened so significantly that we're seeing a fall in demand drag prices lower anyway. So it's going to be likely a worrying CPI report, but potentially not a game-changing CPI report, is probably how I would frame that.
I think one thing I have noticed is that the Bank of England over the past 12 months has been cutting rates into a rising inflation environment. Because when the budget was published, headline inflation was 2.3%. It's now 3.6%.
Yes.
So the Bank of England's cut rates 3 times since that budget. I think it's 3 times, isn't it? Or is it 4?
I think it's 4 times since the budget, actually. It's 5 in total this cycle. One of those was August. So, yeah, it would be 4 times since the budget. So they cut rates by 1% and inflation has gone up by 1.3%. Yeah.
Yeah, no, and obviously the government's not totally to blame for higher food prices, because obviously we have seen spikes in some prices of commodities.
Yeah.
But their policies aren't helping, because obviously you've got higher energy costs, you've got higher transport costs, and you've got higher labour costs.
Yeah,
so exactly. At some point that is going to filter in. So even if you filter out, food costs, the actual cost of the ingredients going up, you still got an underlying dynamic which is pushing up the cost of labour, which will feed into companies' margins, because ultimately they still have to generate a return, update their infrastructure, update their equipment, and obviously pay their staff. So anyway, so CPI next week. We've also got retail sales for July. I've actually been surprised at how well retail sales have held up. I mean, obviously we had that 2.8% decline in May, saw a bit of a rebound in June. What are you thinking for July, given obviously the warm weather that we've seen in July and obviously the sporting events? I've looked at a number of other retail reports for July, and they paint a fairly positive picture for that month.
Yeah, I mean, I think, we often joke, or I often joke, about retail sales here in the UK. If it's a bad print, you explain it with bad weather. If it's a good print, you explain it with good weather. And actually, there is a bit of seriousness behind that joke, because retail sales do tend to evolve in line with the weather forecast. And as you said, we had a very warm July. We had a number of sporting events in July as well, with the Women's Euros and things like that. It does all bode for a pretty positive retail sales report to kick off the summer. As you rightly said, the sort of leading indicators are relatively positive. The one thing I would say is it's worth noting a lot of those leading indicators, the British Retail Consortium, their data, for example, that's value data as opposed to the volume which the ONS tracks. So it is skewed by inflation, which is obviously a big issue, as we've been discussing. But nonetheless, you would expect consumer spending to have remained relatively healthy, which is surprising when you look at other economic indicators and how rapidly the labour market is loosening. You'd have said, well, surely consumer spending should have rolled over by now, but apparently it hasn't.
And again, Barclaycard also painted a picture with a 1.4% increase in card spending. But having said that, that's well below the level of inflation.
Yeah, exactly.
So is it a real terms increase? It's not a real terms increase. It's not, is it?
No, you're effectively paying more for less. And that's how inflation impacts people's back pockets ultimately. But fundamentally, you would expect the retail sales numbers to be pretty solid.
Yeah. Okay. Let's circle back to Jackson Hole, shall we?
Yes. Has your invite arrived yet?
It hasn't. But then again,
mine actually.
I'd have to sort of fly out there and then fly back again, and then fly out to. Well, maybe I could just stay over there and then drive over to Denver. Because obviously it is hosted. It does cover the Denver area, Jackson Hole.
Yes, Wyoming, isn't it?
Wyoming and Colorado. Labour markets in transition, demographics, productivity, and macroeconomic policy is the topic.
Which is
rather topical.
Incredibly topical. It's also, given the July jobs report and the concerns that's raised over the US labour market, it's also, I did a bit of digging into this earlier in the week, the first time since 2014 that the conference has been explicitly on the labour market, which I thought was interesting as well, given how significant a driver it is of absolutely everything. And of course, with the Fed's dual mandate as well, it's been 11 years since we last had one explicitly on jobs.
Indeed, but will Powell signpost a rate cut in September?
Well, if
you're data dependent, no.
Yeah, I think Powell is going to be very, very careful with the language he uses in his address at Jackson Hole.
Is he going to throw Trump a bone?
I think the most Powell will do is lean further into the idea that he already lent into at the July Fed press conference in terms of September being what we would term in the trade a live meeting. Effectively, there is the potential that we discuss a rate cut, but I don't think Powell is going to box himself in and say and pre-commit to anything, because what you've got to remember is Jackson Hole is next week. We expect Jay Powell to speak on the Friday. That's usually when the Fed chair will speak at Jackson Hole. The problem is, between Jackson Hole and the next Fed meeting in mid-September, we get the PCE numbers for July. We get the August jobs report, and we get the August CPI numbers and PPI numbers as well.
Yeah.
So there's a lot of data to come between Powell's speech next Friday and when the FOMC sit down and make that call in September. Do we stand pat? Do we deliver a 25 basis point cut? Do we deliver a bigger cut? Whatever. So I think Powell is going to lean into the idea that discussion will happen. I don't think he's going to come out and explicitly endorse what the market is currently pricing in. And I would argue if he doesn't explicitly endorse that, then you're going to naturally see quite a significant unwind of some of these dovish bets that have been placed in the aftermath of the jobs data and after the CPI numbers this week.
Yeah, I mean, I think he can conceivably cut rates by 25 without upsetting the bond market too much. Because to some extent, they are still well above where the Bank of England base rate is. So they would still be, what is it, 4.5 now?
Yeah, so they're 4.25 to 4.5. So they'd lower to 4 to 4.25. So
which it's still high.
Yeah, I mean that would still be a restrictive policy stance overall,
and it wouldn't be much different to what the Bank of England have been doing.
No, not at all. Not at all. I just don't think Powell is going to want to rule anything in or rule anything out with a month to go until when they have to make that decision. As you rightly say, they are a data-dependent Fed. If you are data-dependent, you want as much of that data as you can before you tell people what you're going to do. Imagine a situation where Powell stands up next Friday, and this could conceivably happen. He makes that dovish pivot. He puts a September cut on the table, at which point the debate then turns, is it 25 or 50? A week later, you get a hot August jobs report. A week after that, you get a hot August CPI number. What the Fed then do? That's why Powell is, I think, going to be trying to keep as much optionality on the table as he can. The other one, of course, is who else will be speaking at Jackson Hole. Obviously, the agenda isn't published for another week or so, but will Christine Lagarde interrupt her summer holiday to pop up? Will Andrew Bailey be there?
Who cares? Who cares? Who cares?
BOJ Governor Ueda, of course. Scott Bessent was saying this week that the BOJ need to hurry up and pull their finger out and hike rates more. So, will he pop up?
I'm not sure they will, I think the Japanese economy is slowing, so why would you hike rates into a slowing economy? Well,
and of course, you've also got various issues in Japan in terms of trade, with the deal with the US, and also politically as well. So
you're not going to do that. Okay, well, so that's Jackson Hole, so it's worth keeping an eye out for. We got flash PMIs for August next week. They're not really going to tell us anything we don't already know, apart from the fact that services has continued to be the outperformer and helped support the German and UK economies. Manufacturing has rebounded from the lows that we've seen in March and April, but they're still well below 50. So be interesting to see whether that trend of improvement in manufacturing continues.
Yes, the story with the PMIs has been the same for goodness knows how long, really. Yeah. Services is doing well enough, manufacturing contracting, but just at a slightly different pace. Sometimes it's the pace of contraction is quickening, sometimes it's slowing, but fundamentally the story hasn't changed for 18 months or so, in developed markets at least. Okay,
so it's earnings for next week. Slightly light ticket, or a light docket for the UK.
Yeah.
The only numbers I could really find were Hayes employment full-year numbers. But I thought it was topical, and the reason I picked it was because with so much uncertainty around UK jobs data, I think if you look at a recruitment agency, they should give you an idea of hiring trends, whether they be permanent roles or temporary roles. And the shares have been in decline since peaking in March. It's dropped around about 30% in that time. They've been very downbeat on labour market trends, not only here in the UK, but globally as well. So it's quite interesting. I don't know whether you've looked at my notes on it.
I have. I've got your notes in front of me here, and I was going to say I think you're absolutely spot on. And it's not only the UK employment data where we've got questions over its accuracy. It's in the US as well, of course. And, the recruiters can help to be a bellwether on that front, particularly in terms of their guidance. That's going to be a huge clue as to how companies are seeing the landscape evolving. And, as we were discussing a few moments ago, the cost of employment has risen so considerably. How is that impacting hiring plans? You would imagine pretty detrimentally.
Yeah, the permanent market is showing broad-based weakness in permanent markets globally. 13% net fee decline in the UK, a 5% decline in Germany. But one thing that did appear to be holding up was contracting. Now, I wonder why that is.
Well, exactly. I think there's two reasons for that. One is because it is much less of a commitment. The second is because, of course, of the various tax implications of that, which can be quite
But you're also not on the company payroll.
Exactly.
So you don't pay the increased national insurance surcharge, which you would if you're a permanent employee.
Yeah.
The contractor basically deals with all his own tax affairs. So that's interesting. It'll be interesting to see if that contracting number shows further evidence of companies' preferences to hold or employ people who are contractors as opposed to permanent staff.
Yeah, exactly. We've got a few earnings in the US next week as well.
We have. We got Walmart, Target, and Home Depot.
Yes.
Let's deal with them collectively, I think, because
why not?
Obviously Walmart and Target, they're the big bellwether stocks. I think if you want divergent fortunes, Walmart shares trading close to record highs, though they've taken a bit of a leg down in the past few days, looking a little bit toppy. Looking for net sales to increase by 3.5% to 4.5% from Q2, but they didn't offer any estimates for operating income growth or EPS due to tariffs.
Yeah.
So that's Walmart, and they are starting to look a little bit toppy. Target's been a bit of a dog's breakfast for about the last 6 months. It's been gradually trading higher, but again, I think their product mix is not helping them. But I think for both, I think it's a good indicator of not only the US consumer at the lower end, but also at the upper end, because you've got Target, which generally tends to cater towards lower income households, and you've got Walmart, who are more middle income to slightly higher income.
Yeah. And of course, the other thing you alluded to it there is how are tariffs impacting the firms, particularly in the case of Walmart. You'll recall much earlier in the year, I think it was April, May time, when President Trump was ranting away about how Walmart shouldn't be raising prices on consumers and they should be eating the cost of the tariffs themselves. So we'll see, whether or not that is having an impact on margins, and also whether they feel comfortable enough, any of these retailers, to be in a position to actually give guidance for the coming quarters or even the remainder of the fiscal year, and whether they see a little bit more certainty on the trade front now than they did a few months prior.
Does Trump realise that if companies eat the tariffs themselves, that stock market valuations will also find that, will be a lot lower as well? Or does he not make that link?
I would put very long odds on him having made that link, to be honest. I mean, this is where tariffs become a zero-sum game. Someone's got to pay them.
Exactly.
It's not as if the way it's framed is, we've put a tariff on the EU. The EU aren't writing a check to pay a tariff. Either the company that imports the goods pays it in the first place. They then either eat it all, and that means that their margins are tighter, which means their profits are lower, which means, as you said, their valuation should come down, or they pass it on to the consumer in the form of higher prices, or they do a bit of both. It's not as if there's a winner from this process.
Indeed. Target was talking about tariffs and the effect that it had on its first quarter numbers. And they blamed a decline in consumer sentiment, uncertainty over tariffs, and a backlash against its rollback of DEI initiatives. Really? Rollback of DEI? I would have suggested that would have given you a boost, but hey-ho. The fact is that Walmart had a good first quarter, so did an awful lot of other retailers. Target didn't. So I'd suggest that's excuses.
Yeah, it does certainly feel that way. Given the performance elsewhere, it smacks of an excuse, to be honest.
Home Depot. It's a bit like B&Q over here.
Yep.
A good barometer of the health of the retail market, but also the housing market in general. They did update their guidance in Q2 or for the rest of the year.
Mm-hmm.
Total sales up by 2.8% and same-store sales to rise by 1%. And they've mitigated their China risks.
Yes, which is a big step. I think just more broadly in terms of the earnings, as you say, they're a good indicator of the health of those various sectors, but also in terms of consumer confidence as well. Generally speaking, if you're taking on a sort of renovation project or anything like that, you're only going to do so if you're pretty confident about how things are going to be looking in terms of your personal life, in employment, all that kind of thing, over the medium term. So if that is another takeaway that we can glean from these Home Depot earnings in particular.
Yeah, they've certainly had a good run since May. Shares are again higher from when they were in May, as are Walmart's, as are Target's. So it'd be interesting to see whether or not they consolidate the gains over Q2, or whether we see a bit of a pullback. Certainly, I think the reaction of the share price today suggests that maybe we might see a little bit of a pullback, but we also have to put the share price action, I think, that we're seeing currently in the context of the fact that we're in the summer holidays. So
yes,
you may see a little bit of choppiness over the course of the next week or so.
Yeah, I mean, markets are. You can already feel that things are starting to thin out quite considerably.
Yeah. Indeed. Okay, so that's pretty much it for this week. Just a quick note to say that next week will be the last webinar for this month, and we will resume just prior to the Fed meeting because I'm on holiday for a couple of weeks, and I think you're off.
I am
at the
indeed.
end of August.
Yes.
So we've got one more. So we've got one more next week.
Yep, and then we'll be back
taking a break.
Mid-September, just before that Fed meeting, and the BOE, and goodness only knows whatever else.
BOE, Bank of Japan, Federal Reserve.
I think we need a holiday before all that, mate.
Well, yeah, I think that's why I'm taking a holiday.
Week. We'll be back next week.
We'll be back next week, and then there'll be a 2-week break.
Yes.
So, anyway, thanks very much for listening, ladies and gents, and see you all same time, same place next week.
Bye for now.